recently or used it a lot. So Chapter 3, Part 1, we're going to be talking about financial accounting. And sort of to begin with, we're going to talk about how the rules get made. Remember, we said financial accounting is constrained by rules. Those rules are called GAAP in the United States, GAAP, which stands for Generally Accepted Accounting Principles. And the set of rules is developed by the Financial Accounting Standards Board called FASB, FASB. And when FASB makes rules, they're working with a set of assumptions and a set of principles. So they're not making them in a vacuum. The assumptions and principles have to be adhered to whatever new rules they make or whatever changes to existing rules they make. And they make a fair amount of sense, and it's interesting, the international standards were developed from the same set of assumptions and principles, but they've gone gone in a different direction. So the U.S. Rules are the ones that U.S. companies have to abide by. International rules are the rules that companies in other countries need to abide by, and there are some other national rules as well. Japan uses primarily IFRS rules, international rules, but they have some unique rules of their own. So every country maybe is a tiny bit different, though the European countries and the British Commonwealth countries, like Canada and Australia and New Zealand and South Africa, all use straight IFRS rules. So the EU and British Commonwealth are all in the same system. The US has its own system. There's been a movement for many, many years, since I think the original idea was in 2004, to converge or make the US system GAAP and the international system IFRS the same. And that was supposed to be done by 2014. It's still not done, and my guess is it won't be done for a long time. Though there have been some movement to standardize the standards, to converge the standards. We're not there yet by a long shot. The primary difference, I mean, there are differences in interpretation between the two systems. The primary difference is that the US rules are rules-based. So there's a rule for everything. How do I treat this kind of transaction? How do I treat that kind of transaction? Whereas the international rules tend to be more principles-based. So here's what we're trying to achieve. You figure out how to get there rather than having rules. Those of you who are mariners are familiar with IMO rules and US Coast Guard rules, and it's kind of a similar system. You've got an international system and a US system, and there are some differences. Once again, the two systems are converging or trying to converge so that they're the same, but there are still different interpretations of rules and different requirements for US mariners than there might be for mariners from another country. So kind of similar, two sets of rulemaking bodies trying to get together and establish unified rules. So let's go ahead and talk about how the rules are made. Oops, I guess I gotta shrink this down so you can see it. Oops. Once. And I'm sorry. Should have done this before I started, but there we go. So assumptions for GAAP. So every set of financial statements under GAAP, and we get these are the same assumptions that IFRS uses, is that first of all, we're only any financial report is for a single economic entity. And it doesn't say a single corporation, it doesn't say a single partnership, it says a single economic entity. And the definition of an economic entity is something controlled by one group. So IBM has many, many corporate subsidiaries, as do most large corporations. So they have a parent company and then they have subsidiary companies. Those are all one economic entity because they're all controlled by one group. They're all controlled by the parent, IBM. So they can be presented as one set of financial statements. What you can't have is, let's say IBM partners with Apple, which is actually the case, on some event. We can't report some of Apple's earnings or assets on IBM's financial statements. They're not controlled. IBM does not control Apple, so we can't have Apple's assets intermingled with IBM's assets on their balance sheet. So that's the essence of economic entity reporting. So if I own a non-controlling share in another entity, it won't show up on my balance sheet or income statement. Their income won't show up, and neither will their assets and liabilities. The value of that investment may show up as an investment, but we won't be bringing all of their transactions into our financial statements. So putting it in local Maine terms, Maine Maritime Academy can't show some of Hassan's assets on their balance sheet an income statement unless they control Hassan University. So that's kind of economic entity assumption. Second one, we have to be able to express transactions and numbers on balance sheets and income statements in some monetary unit. We can't use different monetary units. So if in the US we're going to express our financial statements, we're going to do it in US dollars. If we were a French company, we'd do it in euros. If we were a Japanese company, we'd do it in yen. So everything has to be converted to a single monetary unit on a set of financial statements. The case study you just did, Baron Castine, asked you to figure out what the monetary unit is, and I assume most of you did. It's in that case, we can convert everything to bushels of wheat. That becomes a monetary unit. It's the bushel of wheat monetary unit as opposed to the dollar or the euro, but it's a monetary unit. What that means is we can't put things on financial statements that aren't expressible in monetary units. We can't say we have the best employees in the world and have that show up on our balance sheet. It's not expressible in a monetary unit. Third assumption, periodicity. We have to be able to break our transactions and cut them off at the end of a period, and the periods have to be of equal length each year. So we can't, what we can do is we can have quarters or months of month-long financial statements or quarter-long financial statements or annual financial statements. What we can't do is have irregular time periods. So we can't decide that this year the year is 9 months and next year it's 14 months. We can't say, oh, we're going to have a bad December, let's end the year in November this year, because December is going to be bad and we don't want to show those numbers. So we have to have a regular time period. And then the final piece here, the going concern consumption, is a very important thing and something that a lot of people struggle to understand a little bit. But financial statements only present financial information fairly as long as the business is likely to remain in business or as a going concern. So companies that are at the edge of financial ruin, generally their balance sheets do not conform to GAAP because they don't reflect fairly the value of their assets. They reflect going concern value of the assets, but not actual liquidation value. So recently, many paper mills have closed in Maine. One closed in the town close to us here, Bucksport, close to Castine. And that plant was owned by a company called Verso. And that plant's assets, the plant assets in Bucksport were on Verso's balance sheet at somewhere around $180, $190 million. That was asset valuation, assuming a going concern, assuming the plant continued to make paper. That was the value of the assets. When the plant stopped making paper, the value of the assets changed dramatically and became a scrap value. So the plant is being dismantled, the machinery has been sold off if possible, if not, it's being scrapped. That's the non-going concern. The liquidation value of the plant was far less than the $180 million of carrying value on the balance sheet. So when companies stop operating, fail, their asset value changes dramatically. And this is true not just for manufacturing companies like paper companies. I'm sure some of you have been to going out of business sales at retailers, and you expect to get stuff really cheap. The value of inventory on a retailer's balance sheet is stated at what they paid for it. They may, in the event of closing, stopping operating, they may have to sell that inventory at far less than what they paid for it just to get rid of it. Whereas in the normal course of business, they would sell it for more than what they paid for it. In a business ending situation, they may have to sell it for less. So we assume that any financial statement we looked at is expected to continue as a going concern. Auditors have to make sure that they think that the company will continue as a going concern before they can certify that the statements are presented fairly. So the other thing that guides the rules is financial statements need to be, in order to be useful to the reader, they need to be the following four things: relevant, reliable, comparable, and consistent. So a relevancy means that it's useful to the reader. So is it relevant to the reader? So things that show up on financial statements, the importance is that if they're significant enough to influence business decisions, this is something you'll see a little later on. It's called materiality. Is the dollar figure that you're looking at, if it's incorrect, is the incorrect portion material enough to matter to the reader? So let's think about cash at General Motors. General Motors, let's say the cash at General Motors is misstated by $5,000 on the balance sheet. Is that material? Does it matter to the reader? They have almost $2 billion in cash. If it's off by $5,000, does that $5,000 matter to the reader? Does it affect how you would judge General Motors, how you would use the financial statements? I would argue no, since on the balance sheet for General Motors, they're rounding their numbers in the balance sheet to the nearest $1 million. The $5,000 is immaterial. It's not significant enough to influence business decisions. If you're looking at a local gift store, if the cash is misstated by $5,000 and the gift store has showing on their balance sheet $10,000 in cash, but they really only have $5,000 and they're showing $10,000, is that material to the financial statements? Yes. It is significant enough to influence business decisions, so becomes a part of the relevancy standard. So it's a flexible number. There's no way to say that X dollars is relevant and Y dollars is not. It depends on the relative size of the financial statements. Timely has to be, financial statements need to be released to their readers in a timely manner. If I get financial information a year or two after the end of the year, is it useful? Not particularly. So it has to be done quickly. For public companies in the US, 2.5 months is considered to be timely. So 2.5 months after the end of the year, the company has to publish their financial statements. That somewhat arbitrary number, but that's relatively close to the year end, and therefore is considered to be timely. Reliable, true and verifiable is probably the most important characteristic here, that financial information on a set of financial statements has to be true, and we have to be able to verify that truth. So there has to be evidence that it's true. And an outside party needs to be able to verify the truth of the assets and liabilities on a balance sheet. So it has to be auditable, I guess, and it has to be unbiased. There's a strong bias in the preparation of financial statements because they're prepared by management. Management wants to make themselves look good, generally, so they may be biased to presenting things in a rosy light. That's not useful. So financial information on financial statements should be unbiased, and it should represent faithfully what is actually happening. And then 3, comparable. We need to be able to compare information from year to year. We need to be able to compare between similar companies, and we need to be able to compare to industry averages. Notice it says similar companies. So I want to be able to compare Apple to Dell and to IBM and to Google, and I can do that with financial statements. I may not be able to compare Apple to Peabody Mining, which is a mining company that mines coal. Mining companies and software companies and computer hardware companies are quite different in what they do, and therefore comparability between dissimilar companies is not one of the characteristics that we're looking for in financial statements. It's very difficult to compare a mining company and a software company. They're in such different businesses that the comparability is difficult. So we want to be able to compare to similar companies, industry averages in our industry, and from year to year from one company to another, and within the same company. And finally, consistent. Same rules used every time, allowing meaningful comparison of a company's performance at different points in time. So we don't want to change our standards from this year to next year or from this year to last year. We want to keep them the same so that we can compare. That's the comparability standard just before this. So consistency is incredibly important, because if we're not consistent in the application of rules, then we get different answers. So if you think about sports rules, if we change where the 3-point circle is in basketball, now we can't compare 3-point shots from this year to last year. There's no way to compare how one player did this year and one player did last year, because the rules have changed. So consistency is very important for accounting so that we can use that comparability standard. So those 4 standards really define the qualitative characteristics that the FASB is trying to keep in GAAP. So to make statements understandable and useful, they need to be relevant, reliable, comparable, and consistent. Those are the standards of financial statements. And all rules that are part of the accounting standards, accounting principles, have to meet these kinds of qualitative characteristics. So that's the first part of chapter 3. A couple short questions after this, and then we'll continue on to the second part of chapter 3. Thanks very much for listening.